very excited about this panel. I think everybody tends to discuss macro to death, and so we wanted to talk about the sort of macro things that don't always get discussed. But before we can do that, let's start with the big macro questions. Rather than make this half our conversation, the four big macro things: the Federal Reserve, inflation, the dollar, and the Russian invasion of Ukraine. Tell us about those issues. Are they already in price? Can we start moving beyond them and looking elsewhere? Let's start with Anastasia.
Yeah, good to see everybody, first of all. And by the way, Barry, I'm really glad we're making this like a very abbreviated macro discussion because, I mean, we've been at this for 9 months. And what have we really figured out other than inflation is not transitory? And we're going to be in this for quite some time. But I'll give you my punchline, which I realize 50% of you are going to disagree with. But I think we are in the process of soft landing or headed for a soft landing. And I'll explain that in just a minute. But the reason I say 50% of you will probably disagree, I was at a big client event last week in Atlanta. It was probably 300 people in the room. And I asked, how many of you think that we are already in a recession? How many do you think raised their hand? Like 50%, yeah. Exactly. 50% of the audience raised their hand. So I fully expect half of you guys to disagree with me. But the reason I think we are headed for some sort of soft landing scenario is we are starting to chip away at pieces of the inflation puzzle. And at the same time, the GDP growth is slowing, but it's not falling off the cliff. And if you think about commodity prices are moderating, energy prices are moderating, so that should over time feed into things like food prices, for example. I think consumers are also starting to push back. Like, I don't know about you, but how much longer do you want to pay for astronomical airline fares or hotel rooms or like boxes of cookies or whatever it is? So I think it's getting harder and harder for companies to justify the price increases. And if you look at the surveys, we're starting to see them say they're not going to raise prices as much as they have in the last 3 months, in the next 3 months. So between all of that, slower growth, hopefully lower inflation, and the Fed that I don't think they pivot, but I think they moderate and they stop once they get to, let's say, 3.5%. So if you have the Fed that stops sort of like right as the economy is on the brink, I think that's what gives us a chance at a soft landing, slower growth, but not huge surge in unemployment rate.
Michael, inflation, the Fed, the dollar, what are you looking at that you think is mostly in prices already?
So from my perspective, I do think that the Fed has been the biggest impact on prices all year long. And the terminal rate for the Federal Reserve has been a moving target. When we started, we thought it was 2.25. Now it's 4%. It's always changing. And I think that's likely to continue to be the big story. But picking up on what Anastasia said, I do kind of foresee a time around the midterm elections where a lot's already priced in. So typically during a midterm election year, the S&P falls on average about 19%. This year, 24%. We're in the ballpark. They normally rally, S&P normally rallies post the midterm elections. I think that could happen. You have the Chinese National Communist Congress. So we're going to talk about that. I think that could be a point that you see some improvement in terms of the environment. Ukraine, Russia, I think, as they head to winter, I think escalations will soften there. And as Anastasia said, you have the Fed in both September next week and November 2nd going to raise rates in big chunks. They'll be near done. Markets are going to price in a recovery in 2023.
So you raised a really interesting point I want us to focus on, because I feel like all of us here have beaten to death inflation, Federal Reserve, soft landing, recession, whatever. You mentioned China. I don't think or see or read or hear people discussing what's going on in China. Between zero COVID is almost old news. President Xi coming up on a third term, the big Congress that's taking place. Let's talk about China. How does that impact the macro picture, and how much of the changing environment in China is priced into the stock market?
Well, let's not forget, so China's the second largest economy in the world. They're under a serious slowdown throughout this year. I think many of us beginning this year anticipated that common prosperity would kind of evolve a little bit, zero COVID strategy would change, that China would introduce some monetary and fiscal policy. And it hasn't really worked out that way. So I really am pointing towards the kind of National Communist Party Congress. Starts October 16th. Twice a decade this occurs, and historically in anticipation of, there's a lot of concern, a lot of volatility. But post that Communist Party Congress, markets rally. And so I do think you could have that setup coming in here that once Xi Jinping solidifies his leadership, you could start to see a little of that candy, a little monetary policy, a little fiscal policy to address some of the real challenges in the real estate market, credit market, and export market in China.
So positive change coming from China 2023. What do you see, Anastasia?
Well, maybe I'll, since in the spirit of the bull-bear debate, right, I'll pick up on that. I mean, until and unless China pivots away from zero COVID, and until they really sort of change this, how are they going about common prosperity, it's really difficult to get bullish on China. I mean, there's a property market that needs to be resolved. There's a big tech crackdown that needs to be resolved. But it's really, when are we going to go back from kind of lurching back and forth between COVID to a more open economy? I'm sure some of you in the audience also have this question about, China, Taiwan. And a lot of the market has ignored the Russia-Ukraine issue. And I think the market narrative right now is we shouldn't worry about China invading Taiwan. And I'm certainly in that camp imminently. I don't think that's a risk because there's a lot of domestic issues to be solved. But if I were to identify a potential risk that maybe the market shouldn't ignore, think about what is it that China is actually trying to accomplish strategically. They're trying to be a leader in 5G. They're trying to be a leader in robotics. They're trying to be a leader in artificial intelligence, electric vehicles. Guess what all of that requires? A whole lot of semiconductor content. And guess who's got that semiconductor content? Taiwan accounts for 80 or 90% of the manufacturing capacity out there. I'm not saying this is a military situation, but maybe it's a coercive situation. But my point is, given China's strategic priorities and they need to secure that semiconductor content, I think we should keep that geopolitical risk front and center.
So I do think that if we think about China in that context, it's clear they want to be a financial leader, a technology leader, a military leader, an economic superpower. So there's a limitation as to how far they can push common prosperity, the crackdown on technology, for example, how far they can push zero COVID strategy. That's why I do think post that Communist Party Congress meeting, it's a mouthful, so it's going to be a bit more of monetary fiscal policy, and you'll begin to see that shift we've all been waiting for. But some of the structural challenges are there, and until we get there, expect some volatility.
So last China-Russia question before I move to some more issues that might not be in price yet. What is the lesson that China learned from the world's response to Russia?
I'll go first if that's okay. I mean, I think China has learned that the world is willing to take action, but there's a limit to that action. That action is going to be financial, that action is going to revolve around sanctions, and it's not likely to be military. And the thing is, it's really difficult to sanction an economy like China, for example. To kind of pick up on my train of thought there before, US or Europe or nobody else can really afford to disrupt that semiconductor relationship that right now happens in Taiwan. So we can't afford to disrupt the energy transition for which we need the solar panels, and like 80 or 90% of them are actually being manufactured in in China, excuse me. The rare earth materials, the silicon, the polysilicon. So I think it would be really difficult for us to act meaningfully in terms of sanctions without hurting ourselves. But I think that's the lesson that China has learned is we'll try to do what we can, but it's not going to be military, and we probably will end up shooting our own economy in the foot as a result.
You same place?
Similar. I think that China observed that there's going to be a coordinated world response to any military conflict, and they're trying to figure out what to do next in terms of next steps.
And it will be costly.
And it could be costly to both sides, I would agree.
So you brought up the issue of manufacturing of solar panels and photovoltaic equipment. Let's talk about climate change. We really haven't discussed that as a risk to the markets, and I don't know if the markets have really incorporated that. We're here in Southern California 2 weeks ago, over 100 degrees, very uncharacteristic, tropical storm, drought, water shortage everywhere. What does this mean to the global economy? What does this mean to stocks and bonds?
I think it's a great opportunity. So let's move the conversation away from ESG, non-ESG. It's controversial. It's in the headlines. Let's just think that the U.S. government just passed the Inflation Reduction Act with $400 billion that's going to be spent towards kind of alternative energy, clean energy. That's 4 times the amount that was passed in the 2009 Recovery Act. So no matter how you slice it, from an investment standpoint, regardless of your ESG opinion, climate change opinion, there's going to be a significant amount of infrastructure spending. There's going to be a significant amount of projects that go on to address climate change. And I think that that's an investment opportunity going forward.
I happen to agree. I agree with you, Michael. Let's move away from the ESG and impact and all this. I think of it as the sustainability decade. And what I mean by sustainability is how can we be the most efficient with our natural resources without damaging the environment, and also at the same time making sure everybody has access to basics, clean water, clean air, and food. And that's what sustainability investment theme megatrend really tries to tackle. And there is an economic impact. We should be thinking about how this impacts the economies. So I'll give you a couple of examples that you alluded to, hot temperatures. But if you look at the number of extreme weather events, in 2020, there's 350 events globally, whether it's hurricanes or floods or droughts and whatnot. That was up from 200 in 2000. I mean, draw your own conclusions, but if you overlay the chart of extreme events with the rise in global temperatures, that's a pretty highly correlated chart. So what happens in that case? What happens if you have a hurricane? There's an economic cost. There's displacement, there's lost productivity, there's rebuilding, there's cost of insurance. So I don't exactly know what that adds up to, but if you think that there's 300 million people in the world that are at risk of being displaced due to rising sea levels, that's going to add up to an economic cost. And I was reading this book a couple of days on the plane, and there is a flooding issue in Bangladesh and there, I think the Maldives. And who do you think the local population wants to pay for the relocation costs rising from sea levels? The countries that are presumably responsible for being the worst emitters and who are responsible for the climate change in the first place. So my point is, every one of us should care about that, because I think there's an economic burden that comes back to some of the economies right here.
So let's talk about the investment opportunity that presents itself. When we were chatting before the event last week, the word that I have kept hearing come up from both of you was innovation. Where is from a macro perspective, where is the innovation? How does that present opportunities to investors? And what does it mean for the whole global economy?
I like how you put it in our prep session, so I don't want to steal that. You had kind of your
for it.
3 areas, so I think you should kind of kick that question off
Okay.
around digital transformation, healthcare, and climate. So I don't want to steal all your good stuff.
I'll
Go
lay the
ahead.
groundwork, and then we'll
then
break down
we'll
it.
then we'll go.
Well, I used to be head of thematic strategy at JP Morgan, so I'm actually stealing that from my prior role. And, we talked about 3 mega trends that are forces that are going to change and shape and really disrupt the world as we know it for years to come. And I always thought of it as in 3 different buckets, which is digital transformation, healthcare innovation, and sustainability. And when you think about something like digital innovation, the amount of data that's in the world today is going to quintuple over the next 10 years. And if you think about the data that we can possibly humanly grasp and analyze today, it's 1%. So we make sense out of 1% of the data that's out there. But this is all the data that needs to be collected, connected, processed, analyzed, and protected. And this is why it leads to investment opportunities like cloud and cyber and artificial intelligence. And I'll pick up on that in a minute, but I think that's one of the greatest investment opportunities that we have today. The second bucket is healthcare innovation. This is not just COVID that yielded vaccines, but if you think about healthcare innovation, today we have an opportunity to solve disease computationally. We can arrive at new molecules by using the data sets that I mentioned, which there's a tremendous amount of data in healthcare. If you apply artificial intelligence to crunching that data, then you could potentially come up with better treatments that are more precise, that are right for the right patient at the right time. So I'm super excited about that. And of course, sustainability, which we talked about.
And what I want to focus on is a little bit more on the investment, kind of the why now type of thing. And what's interesting is if you look at the 75 fastest growing companies in the US, 40% of them miss their earnings estimates, half of them make little to no money. So you get the picture. It's the disruptors, the innovators, the biotech companies, and their performance has been terrible. So in July of 2020, those peaked at the market in terms of price to sale at more than 7 times. We don't use price to earnings because I just told you most of them don't earn any money. So that was their peak. Today, they only trade at twice the market's multiple. Now, over the same kind of similar period year to date, on a relative kind of return performance, they haven't had this poor performance in 7 decades. And when these two conditions meet, historically, over the next 12 months, those 75 fastest growing companies tend to beat the market by, on average, about 6%. And it's not just a flash in the pan. It's not just a one-time thing. They do it about 80% of the time. So I think Anastasia did a great job outlining the kind of different concepts: digital transformation, healthcare, sustainability. And I think it's kind of an interesting time. Do you expect many of those companies are down 40, 50, 60%? You might catch another 10% of the downside, but do you expect that they're going to be down another 60, 70, 80%? I don't think so. So as we look towards the investing and building portfolios, I think it's an interesting opportunity for that time for that innovation, that disruption in terms of the companies.
I definitely agree with you, Michael. The valuations in some of these things have been reset significantly. And clean energy, for example, is something to talk about. If you look at the valuation, I mean, it's probably half of what it was going into 2021, and it's sort of stayed there. But if you look at the earnings growth for a lot of the clean energy companies, they're projected to grow at 22% over the next several years, outpacing the S&P 500 by a factor of 2. So that's where the growth is. And so when you look at a multiple of something like that and you adjust that for a higher growth trajectory, that is actually a secular sector that is trading very inexpensively relative to its own history and relative to the market. So you see a lot of opportunities like that. I will also say, maybe as a segue into kind of the private market world, is
my next question.
I love innovation.
Funny how that works.
It's out there in the public markets, but guess what? There's a lot of it, a lot more of it, that's out in the private markets. So I mentioned
a lot more of it. You're saying when we're referring to private equity, venture capital, there's more innovation in that space than the public markets.
The companies that they back, the PE and the VC-backed companies, are by definition more innovative. They're earlier in their life cycles, and as a result, we're talking about revenue growth that's potentially a lot more significant. So I'll put some numbers around it. I mentioned artificial intelligence, probably the biggest commercial opportunity that we have today. And back at JP Morgan, I try to put together this cute little basket of artificial intelligence stocks that are publicly traded. Well, guess what? You could do NVIDIA, and you could do Google, and you could do some of others, but is that really artificial intelligence, or are these just some of the big tech companies? But if you look at the number of artificial intelligence companies that are available in public markets, it's 58 times more. So that's where some of this is being driven. If you look at biotech, there's 10x the number of innovative biotech companies, and that's available in the public market. So that's why I think if you're going to invest in the spectrum of innovation, you got to look to private markets as well. And sorry, Barry, the last thing I'll say about that, one thing we saw in 2021, the late-stage venture companies, they IPO'd at a crazy multiple. I mean, is anybody surprised that the IPO class is down 70, 80%? No, the multiple was crazy. But if you're really trying to invest in innovation, you want to get in some of the earlier stages and realize that valuations step up at still reasonable multiples.
How about you, Michael? What do you think about PE at these levels?
Well, I think one of the interesting ththings is right here in California, CalPERS, if you look at their kind of their fiscal returns, they have the S&P down over the last year, and they have their private equity up 20%. That doesn't seem to reconcile with me. So when we talked about China, when we talked about climate change, some people get a little concerned. I think the valuations are there and the opportunities there. When it comes to private credit and private equity, the growth has been tremendous. There were 100 private equity companies at the turn of the century. There's about 7,000 today, and assets have increased tremendously. And so what's interesting is you look at something like Davos, which they didn't have in the winter, maybe from climate change they had it in the spring or something, I don't know. But there you had a private
and Delta pushed it forward.
Absolutely. But the private equity bankers there are saying, we're immune to a recession. And I just don't think that's right. So my concern there is that valuations need to be marked to market. They haven't been yet, and I think that's another shoe to drop. Now, again, I'm not saying it's all private equity is bad. All I'm saying is valuations are high. The number of managers, the number of assets has grown. The interest in terms of to the financial advisor market has expanded broadly. The number of choices you have, how many emails, calls do you have, that to me is a red flag. And so I think when people talk about, hey, where could the next source, they ask strategists like us, where could the next source, what's the next mortgage crisis, what's the next TMT bubble bursting? I'm not sure private equity and credit are big enough, but sure, they are prevalent in terms of what they now look like.
So it's late stage, but it's not like Kim Kardashian is launching
I mean, that's actually a little scary, right? That right there.
Right? Sometimes they do ring a bell.
Yeah, but can I pick up on kind of the growth in private markets? I mean, you're right, it has been stunning, and private equity today is 6.3 trillion AUM, and it's 1.2 trillion in dry powder. So there's been significant growth. I would argue that I think it has grown in line with the opportunity set. I mentioned that there's a lot more AI private companies and public, but overall there's 5 times more private companies out there than there are public ones. And the reason why there's been this proliferation is because they wanted to incubate those business ideas privately. They didn't want to tap the IPO market. And the average age of a company that stays private is about 11 years. It was 7 or 8 at the turn of the century. So I think that's what the private equity and venture capital have backed, and that's where all the innovation is. The reason why I don't, so that's one of the reasons I don't see that being a bubble just looking at the assets under management. The other reason, if you think about who historically invested in private equity, it has been institutional money. For institutions, it's a 40-50% allocation. For ultra high individuals, it's probably like 15 to 20%. In the wealth management community, the stats are that 30% of wealth management advisors, this is great, allocate to alternatives. And of the ones that do, allocate 3%. So I would argue, Barry, that you haven't had this proliferation of investment in private equity so that you can potentially run into a wall of liquidations. Having said that, there are pockets, not necessarily private equity, but against venture where late-stage valuations have skyrocketed, and I don't think those absolutely need to reset, and I think they will in the next few quarters.
So when we look at, last private equity question, when we look at real estate funds, typically they'll take 25% of their holdings, they'll do an audit, market, and each year they end up reviewing their whole portfolio. Do we see PE doing that same sort of thing, or is it a little more subjective and what would you like it to be worth sort of thing?
No, I think there's more of a structure to the pricing. I just think there's a lagged effect for private equity valuations. And so I think public markets have priced it in first, and you're likely to see these things marked down. And when they are, I think it'll be interesting in terms of its peripheral impacts on public markets, on credit markets, those types of things. I wouldn't underestimate kind of some of the risks there.
All right, so you mentioned Davos got pushed forward. I think that was Omicron and Delta related. When we started conceptualizing this event, part of the reason to do it outside was we were all locked down at home and couldn't wait to get the hell out. But part of it was we don't know what the world's going to look like a year from now. Outdoors should be safer. Maybe that was a excess of being a little caution, an excess of caution. But still, here it is a year later. 40% of people are going into the office. Lots of people are working from home. Here's something that we haven't talked about that may not be in price. What do you think about this transition to work from home? What does this mean for inner cities, for downtown, for corporate culture? Seems like it's a big issue, and we're really not hearing a lot of it talking about how that impacts markets.
Well, I think now you're starting to see more and more headlines, especially in our business, right? Larry Fink, Jamie Dimon, they're all coming out suggesting, hey, we want and expect people to be back in the office. So I do think the trend will begin to shift in terms of, as we move further away from some of the pandemic aftershocks. I do anticipate that you'll see more people in the office, more return to downtown, and that'll be good for those real estate values, for those businesses from that perspective. So I expect a little bit of a softening in that trend going forward.
I hope you're right, Michael, although it seems like there's a fair bit of pushback on the return to office, but I hope you're right. If you look at the vacancy in office real estate, it's something like 12 to 15%. So we need a lot of people to potentially return back to the office. And by the way, it's never like 4% vacancy. So but it's slightly above the historical average. But if you look at apartment vacancies, for example, it's like 2 or 3%. And we all feel that as we pay higher rents. If you look at industrial real estate, the vacancy rate is 1.7%. So I actually think that might be an interesting real estate redevelopment opportunity. And can we take some of the office space that maybe we don't need anymore, and can we repurpose that for multifamily residential? Because we got to get those rent prices down. Can we take a retail shopping mall that's dead, outside of, the big city somewhere, and can we repurpose that to be a distribution facility? I think that's what a lot of the real estate operators are thinking about. The last thing is reshoring. You probably all saw the Google chart, showing the number of the number of mentions of reshoring, or maybe from company earnings, and we talked about China, Taiwan. We talked about needing to secure supply chains post-pandemic. Guess what? A lot of companies are bringing stuff back home. And that stuff may need to be distributed locally. So you need to build more logistics and industrial warehouse facilities. You might need to build more life science, manufacturing centers. So I actually think there's a big secular trend of reshoring that's good for local real estate.
How about yourself, Michael? What are your thoughts on work from home in the office? Is this ever going to go back to the way it was?
This is good, by the way. Like, we could do this.
I don't think it'll ever go back to the way it was. I think a hybrid model is probably the future model, or the current model, and will continue to be for some time. So again, I think it underscores some of the innovative things that we had talked about earlier in terms of the investment opportunities for work from home and some of the technology that goes there. But no, I don't foresee a full shift to 5 days a week in the office anytime soon.
All right, so we have 5 minutes left, and I want to leave everybody with a takeaway. So let's come up with an idea. What should they be bringing back to the office when they go home about the state of the macro world and investing? Let's start with Anastasia.
So I'll do 3 things, but I promise I'll make them pretty quick. I mean, the macro environment is unprecedented, is uncertain. Who knows how long it's going to take us to bring inflation down? But in the meantime, I think there's 3 things that are investable themes. The first one is buy things when it feels terrible to do so. If you look at buying stocks and when they're trading at 20, 25 times multiple, guess what? Your forward-looking returns on a 1-year or 5-year average basis, they were flat. But if you're buying stocks that are trading at 16 or 17 times multiple, which is roughly where we are today, historically, going back to the 70s, your forward-looking returns have actually been positive and double digits. So as bad as things felt, and maybe still do, I think buying things when they're on sale makes a lot of sense. The second theme, which I'm sure that one resonates a lot with your client, is get paid while you wait. Wait out this volatility. And coming into the year, there was really no way to get paid. High yield was 4.5%, cash was 0. Well, cash is going to be north of 3%. The 1 to 3 year munis or treasuries are going to be yielding more than 3%. Real estate, 4% yields. Private credit, close to 9% yields. High yield, 8.6. So there's a lot of ways to get creative yield in your portfolio. And the last thing I'll come back is the commit long-term capital now that's going to be deployed over the coming quarters. I am completely with you, Michael, that in the coming quarters, we're going to see the needed reset in private equity and VC valuations. But guess what? If you invested in downturn vintages, your forward-looking net IRRs tended to be better. So again, this is the time when you want to be deploying that capital. So tough markets, but 3 things to do.
So from my perspective, what the pandemic reminded us all of is that the economy isn't the market and vice versa. And we know that investors will begin to price in a recovery in the economy far before the economic data and earnings bottom. So we look at our Spider Exchange Traded Fund flows and we see what people are doing. T-bills, gold, defensive, healthcare, staples, utilities. So what I'm suggesting is it's now, I understand where you are. I want to more understand where you're going. And so I do think that kind of when investors begin to price in that recovery, value stocks, small cap stocks, and things that benefit in the early stages of the recovery, those are cheap and they're likely to benefit when that happens. To me, those are the 3 takeaways.
Tremendous panel. Thank you so much. I'm seeing we're out of time for questions, but let's hear it from Michael and Anastasia. Really great stuff.
Guys.
Right.